Thank you to everyone for sticking around, especially with lunch coming up. And the focus here is capital flows, and particularly capital rotation across asset classes. We want to do quick introductions. I'm happy to kick off. I'm Aidan Thornton. I'm a vice president with Stepstone Real Estate. We focus on secondaries, recapitalizations, and co-investments, mostly investing out of our latest fund, Stepstone Real Estate Partners 5. So happy to turn it off.
Sure. So Lourdes Fisher, I'm a senior managing director at Bridge Investment Group. I co-lead the capital formation team. So we're a $50 billion in AUM platform, as you guys probably all know. We were recently acquired by Apollo. So we're the real estate equity business on a go-forward basis. We focus mostly on residential rental across workforce housing, market rate multifamily, BTR, and seniors, and then logistics across net lease and value add, as well as have a small balance debt fund.
Hi, everybody. I'm Max Pastor, Chief Operating Officer of Time Equities, Inc. For some of you who were here for the prior panel that Francis Greenberger, our chairman, did, I'll keep our description rather short. We are a 50-plus-year-old private, fully integrated real estate investment company, and we play in all the basic food groups of industrial, multifamily, office, and retail, but tend to shy away from operating businesses such as hotels, self-storage, and senior housing.
Great. Lourdes and I were catching up before this, and I think before we get into specific asset classes, obviously with the political environment in the U.S., there has been some concern about retrenchment from offshore capital. I'm just curious, how are you seeing demand from the LP side for commercial real estate in the U.S.?
Well, it depends on the type, whether you're doing debt or equity, and where you're looking outside of the U.S. Our experience has been that offshore capital is still flowing into U.S. real estate across both the debt and equity side. We've seen from a debt capital interest, it's certainly been driven by our relationships in Asia, a little more conservative in terms of how they think about investments. They like the distribution, the yield profile that debt investments can offer on a risk-adjusted basis. But away from that, we've also experienced capital flows from the Middle East, Europe. It continues to come into the U.S. It's certainly on the back of the tariff noise. There were a lot of questions about Canada and retrenchment there, and I will say that the Maple 8 certainly are still deploying, but some of the smaller Canadian pension plans that we work with, they've been told by their ICs that any investment in the U.S. is going to take a pretty significant lift. So obviously on our side, we continue to have conversations, but generally offshore capital has been, has not stopped. The U.S., different story, and more so just because of the types of investors that we deal with on the pension side, just being much more mature in their capital allocation process and their private markets allocations, particularly within real estate. And that tends to be a much more zero-sum game versus outside of the U.S., they are moving away from Europe, local markets, and deploying into the U.S. markets.
Great. Max, any kind of view there?
Yeah, our view is a little bit different just because of who we are. So our capital base, from an investor standpoint, isn't institutional. A lot of the equity that we invest is in-house and recycled, as well as we raise capital through broker-dealer network. We're launching our 7th fund in that industry basically as we speak, but that's a vast majority of the people are U.S.-based investors. I think where we're having discussions about capital and is it going outside of the U.S. or coming into is really how we're deploying it through our investments and acquisitions. So as we look around, we're currently in 37 states and 7 countries. But as we were putting together our prediction of 2026, where we'll be investing, we think it'll be about a third of our new investment will be in Europe. And that's greater than it has been in the past, but we've had a significant exposure there for 15 years or so.
Yeah, certainly our fund as well as our co-investment accounts invest across the U.S. and Europe, to a lesser extent Asia. And I think in Europe we've seen it be far less intermediated than in the U.S. and creating opportunity therein. I will get back on the scheduled script. So as you think about capital allocation going forward, what asset classes are shedding investor favor, and where do you see opportunity going forward?
So we're a little bit different in that we don't set our allocation percentages or parameters by product type at the beginning of the year. And we don't start off with a number that, for instance, we want to be 50% office. That's not really how we evaluate deals. What we try to do is follow our core principles, right? We want to invest at a low basis. We value in-place cash flow, and we detest negative leverage, right? So we start there. And then you start asking yourself, well, where can I find those opportunities? Although it's not a favored asset class at the moment, the dislocation and value of office buildings provides the greatest opportunity on a deal-by-deal basis. So we are evaluating a lot of office buildings. We've continued to see strength in the industrial market. We shied away from the last few years being in like bulk warehouse sort of Class A and really focused more on Class B industrial, shallow bay manufacturing spaces. We've seen more durability there. Retail's continued to be very strong, and multifamily, I find it's market by market. From a macro perspective, which we can get into a little bit later, I think there's really good fundamentals in multifamily, but on a investment standpoint, it's really on the micro basis and what's the deal and what's the sub-market you're looking at.
Yeah, happy to share my perspective based on conversations with investors. Obviously, we really focus on resi and logistics, which we have long-term convictions on. And what we do on the residential side is really high-growth secondary markets like a Boston, a Tampa, a Jacksonville, a Phoenix. And we come in and out of those markets depending on what the supply dynamics look like and our ability to drive rent growth. We're vertically integrated, which we believe allows us to really be very nimble in terms of driving that operational execution. Depending on which investor you're speaking to, those sectors continue to be in favor. The challenge is that they've been in favor for so long that if you're speaking to institutional accounts, they have an overweight there. And so generally speaking, and they have to continue to have high conviction to be able to continue to be overweight. Now, taking my just lens of the conversations I have with other investors, data centers is, it's the niche sectors that has really been in favor throughout all of this year with the majority of accounts that we speak to. So that's data centers, it's seniors housing, which we have a business in. That space, given, frankly, I'm sure everyone saw the Green Street report at the beginning of the year. Which ones are the sectors that are going to drive NOI growth? It's MH, it's seniors housing, data centers, just because of the secular foundational tailwinds there. That's generally been where a lot of accounts that we work with have been allocating capital. And then on the data center side, the question becomes, where do you play? And it's really been on development, just because the core yield or rates that you're getting there are really expensive. The challenge I have, and welcome, thoughts here on the panel, is so much development, so many dollars are going there. What's the exit, and what does that look like? And that's the conversation that a lot of our investors are having with the managers that specialize there.
Yeah, I certainly have been involved in the data center space, building powered shells, and every time a core fund decides to increase their data center allocation, we get really excited because the what is the exit question, I think, is pertinent to everyone developing in that space.
Just on data centers, if I may, we've had some exposure to them through our legacy portfolio or assets we've already purchased. It's really hard to make the numbers work on an exit given the development costs and the cost of power to bring in to these facilities. What we found was in a lot of the industrial properties that we acquired and even some office, there's a lot of existing power infrastructure that was underutilized but is incredibly expensive to replace. And I think what's happened with data centers, if you look in over the past 5 years, is pretty interesting because they weren't so valued just a little bit ago. We bought a loft office building in downtown Cincinnati about the day COVID started. I think it was February of 2020 when we closed. And one of the perceived challenges with that property was there was a data center on about half a floor with this tremendous build out, and everybody was saying, you know, the servers are getting smaller, they're not going to need the footprint if they go out of business. This is going to be a fortune to replace, and it really sort of held the deal back as far as other competitive bidders on it. And then what's changed in that market to view it, yes, the technology got smaller, but what was a liability is now sort of an asset. They're expanding and taking another floor in the building, and it's solely really because the power was in this building because it was a former loft factory, and they really can't economically go to somewhere else because the cost of putting in that electrical infrastructure. So, you know, the cost of utilities and upgrades to the grid are, you hear those things in the news, but in real life, they actually come into play and matter.
Yeah, I think it speaks to, as you mentioned earlier, market by market and asset by asset specificity. And Lourdes, you were alluding to this as well with your market specialization. I mean, if you think about multifamily, we saw incredible overbuilding in the Southeast predominantly, and because of where things were trading as a result of convexity, seeing, you know, X basis points increase in the cap rate just resulted in a huge value decline. But we've started to see opportunities where if you're able to buy the reset basis and put on, you know, equivalent or slightly positive leverage in a market where the supply has been absorbed and demand continues to, you know, unabated, we think that those are really, you know, interesting opportunities. So I think, to your point, sector by sector, but also property by property is key. Anything else on what's shedding investor favor, or should we think about how to figure out market softness?
Yeah, I mean, the only thing I would add is on the senior side, because we have that business, one of the elements that has become, or the feedback we receive from investors, and, you know, we partner with you guys on our business there too, is operating businesses or having in-house operating businesses is becoming incredibly important, or the fact that is important in terms of driving value, because you're really focused on not only what you're generating from a revenue perspective, if you're working with in an allocator model versus a vertically integrated model, that the driving of expenses and really driving synergies on that side with labor costs and everything else that's happening there because of the operational intensity is pretty important. I mean, we've had a lot of conversations with investors specifically on that point, particularly because there's not a lot of private players out there that have that vertical integration.
I guess thinking about real estate fundamentally as two markets, right? You have the market for space, and then you have the capital markets for investing in real estate. I think there is, in some ways, conflicting signals where in the markets for space, either on the supply side because of deliveries or, you know, expectations of a secular decline in economic growth, leading to a decline in demand. And at the same time, you have really pretty meaningful inflows into capital demanding U.S. real estate. How do you think about kind of navigating those two elements of the same coin?
Well, I think the capital inflows into any asset investment is overwhelming right now. I mean, capital is wondering where to go. I checked this morning because I didn't want to give a wrong statistic, but I think there's over $7.3 trillion in money market funds right now. So you look at that capital sitting on the sidelines. If rates continue to diminish, do people pull out of those funds and try to get a higher return by going back into the stock market or into private capital investments such as real estate? So I think what we have to do is really stay disciplined to making good investment decisions, regardless of can we raise the capital or not. So, we are highly focused on the quality of our investments and also what we can provide to investors. And it's a challenge when you look at what's going on out there. I mean, we are not a shop that does deals just to do a deal or because we can raise the capital. We really stay focused on, where can we buy value in dislocation. So it could be stabilized assets, it could be value add, but we don't just invest because there's a lot of capital out there that we can raise.
I think the challenge is there's also just not been a lot of activity, right? So if you're an investor, you're not getting distributions back because there's not a lot of sales, at least in the markets and in the assets that we participate in. And so a lot of the conversations tend to be, well, I'd love to work with you and I'd love to buy more deals, but I need my capital back. The dynamic of core funds also continuing to have these massive queues on the institutional side remains a heavy topic that investors are focused on, or LPs are focused on. I was just meeting with one of the largest Texas plans this week, and they said they've been in a queue for a major fund for 3 years. So you're not seeing that rotation that typically naturally happens in periods of stability. And then if you do have dollars to put to work, the question is, well, how long are my dollars going to sit there accruing fees before you actually find enough assets to deploy? And so that is a pretty significant disconnect we continue to see in today's market. Hopefully rate cuts help with that, and the bid ask between buyers and sellers continues to narrow. It's certainly better than it was last year, but I think we still have a ways to go.
Yeah, I mean, shameless plug. We see that need for liquidity as an opportunity for players like us in the secondary market. And I think to your point, as the bid ask has narrowed a little bit, we've seen LPs get, really serious about, engaging in a fund windup or, selling off an LP interest in a fund. We predominantly do GP-led secondaries, so we're actually buying the assets, but that demand for liquidity has, I think, strengthened. And you alluded to it, and this is not a novel phrase, but I think DPI is the new IRR.
Yes.
Something that everyone says at every conference now, so we've checked it off the list. But even if it's to give the same GP capital in the next fund, LPs are demanding kind of distributions and repatriation of their capital.
Well, I think, Aiden, the growth of firms like yours and the secondary market and the secondary funds is really, I think it's going to continue to expand, and it's going to become an integral player in the market, because essentially we've had a lot of LPs go into real estate investments. They are asking for liquidity and looking at DPI, but essentially they're investing in an asset class that is not liquid. Mm-hmm. And everybody tends to want to hold up their hand and redeem at the worst possible time for valuations. So I think the secondary market players like yourself, that's going to continue to grow in the next couple of years.
And we do like to think of it as, we are partnering with GPs who their LP may need liquidity, but they see tons of value creation opportunity. So it's not just providing a liquidity solution, but to your point, if someone wants to get out at what might not be an optimal time for the investment, but might be optimal to them from a liquidity needs perspective, we're happy to partner with that GP and hopefully build it into a programmatic relationship. I think, Lourdes, you mentioned niche, and we talked a little bit about data centers. How are you thinking about what role niche sectors, data centers, life sciences, senior housing, we can kind of argue what is truly niche. But from a portfolio diversification perspective, what role do they play today?
I think you're going to continue to see allocations to those sectors. You've seen the NACREIF composition of what an Odyssey fund composition looks like change. At some point, office, we looked at this data a year ago. Office pre-COVID was about 25% of almost every Odyssey fund. That has obviously shrunk pretty significantly because of the degradation of value and just how much capital has flown into multifamily and industrial. In 10 years, will office, make that level of composition in Odyssey? No. And then you're going to continue to see that other bucket increase. Again, the investors that we mostly spend time with, or I mostly spend time with, are the large institutional players who very much track what is happening in Odyssey and as a benchmark, and then what that composition looks like for their portfolios. There are investors that are very focused on, and then there are others that are strategic and nimble and want to be forward thinking and plowing capital into these niche sectors early so that they can outperform a lot of their peers. But I don't think data centers are here to stay. The question is, the scale and the level of development that we've seen, is that going to abate over the next 10 years? Manufactured housing, the desire to build more affordable homes is increasing significantly. We play in the NOAA space, so old properties that exist in the similar markets that we buy on the market rate side, but we've also been very active in MH, and now as part of the Apollo acquisition have a very significant manufactured housing portfolio that we're going to continue to grow. It generates really stable income for investors, and if you're looking to hold it long term, which some of the institutional players that we work with want to, they just see it as an income play. Obviously, for institutional accounts, though, reputational risk is a factor when dealing with MH, but that's not going away. Seniors housing, in my view, it was, what is it, it's the aging avalanche is now the moniker that folks use. We're an aging population. Where can we put high quality assets to provide the continuum of care? So that, in our view, is going to continue to be a big theme.
Great. Next.
From our point of view, I think it depends on the actual niche and how narrow is it. We're very well diversified, so as I had said previously, we do pick up exposure to those asset classes. But as far as manufactured housing, I view that a little bit more as just multifamily, and maybe it looks a little bit different than a garden-style apartment, but it's still in the asset class. And when you look at multifamily, whether it's build to rent, manufactured housing, the macro fundamentals are there, right? We're, I think, 10 million units short of what we need today, and the supply side's about 500,000 units a year. So that feels good. When it comes to something very narrow, like senior housing, I think we give some pause as to what the population and demographic trends are. We have a huge generation moving into that and through that system, not to be morbid with the baby boomers, but are we going to be in a place where we have way more units and beds than capacity and at some point, in the next decade or plus? I could see that. So I think that's probably an area, we don't want a lot of exposure to. But we evaluate things on an individual basis as far as the niches go.
The one thing I would say is I think data centers will become just a core component of the portfolio, just because of AI and technology transformation. Seniors, I agree with you, right? Seniors and MH, it's resi rental, so broader residential. But I do think core data centers should be just another component of a core portfolio.
I think it almost becomes like a utility.
Exactly.
Yeah. How do you, just staying on that topic of niche, how do you think about operational intensity? In Max, you mentioned small bay industrial, which, as you know, is far more operationally intensive than kind of large block space, to the benefit of owners. And obviously, Lourdes Seniors is an operating business, maybe more akin to hospitality than traditional multifamily. How do you think about dealing with the operational intensity of some of these niche sectors?
Let me take shallow bay industrial because that's an area I know well. It is incredibly management intensive. Another unique aspect of it is, yes, we oftentimes buy under market rents. Let's say they were $4 in place net and the market's $7 to $8 net. That's the headline. The reality is it may be 150 tenants in an average bay of 2,000 square feet. So how do we execute doing that? It's a lot of leases. It's a lot of tenants. I can't emphasize enough how key it is to have great people on the ground. And where we've been successful at that is we built a team out in the market, in the sub-market, not all of employees, but we found the right managers, the right leasing teams. It's you have to find the right leasing team that's motivated to do smaller deals and a lot of volume, then wait for a very, very large tenant because that's not the business model. And if you can't find and locate those people, it's very hard to buy the assets regardless of the market because the operational quality is key to driving the return there and executing the business plan.
So we believe that across every asset class that we manage, right? So we're vertically integrated across everything, including MH. Because to your point, to us, it's really important to drive synergies on an economies of scale basis, but also just the business intelligence that you gain by having boots on the ground that are day in, day out, understanding what the tenants want or what the customers want, and then feeding that in to our systems. We can be a lot more nimble in moving rents or making decisions. And look, if you're in an allocator model, you're working with a bunch of different operators that could potentially be doing very different things across procurement, again, leasing, et cetera, versus we have one mantra across every single vertical. So we think it's really important. And I think, more and more investors are understanding that the power of that vertical integration.
Yeah, I mean, as someone who invests with GPs through secondaries or co-invests alongside them, GP selection and their ability to execute on business plan, I mean, is paramount, especially in those niche sectors. So I think we see a lot of folks diving into areas with strong fundamentals on the supply-demand fundamental side, especially those that are difficult to access at scale. Small bay industrial and MH are both great examples of that. Where do valuations look stretched despite market headwinds, and how do you think about positioning yourself, for potential corrections?
I think it's also market by market, and I mean, we bought an asset in Boston on the market rate multifamily side inside a five cap, which when I looked at the case study, I'm like, why are we doing that? But in that market, you haven't seen cap rates really move, and we were able to secure a mortgage that was inside the 4.75 cap rate that we bought the asset in. So that's an example of valuations continuing to be pretty tight. And then the decision you have to make is, do you really like that asset? Do you really like that market? What is the financing structure? And then how quickly and how far can I grow that and expand that cap rate? Our business plan assumes we're going to get low sixes through 4 years. So I feel pretty good about that. But there are, look, MH is an example where it's really tight. Capital has been chasing that sector very hard for the last couple of years, and to get anything in scale on a portfolio basis is really, really challenging, just because of all the capital has been chasing that. Industrial logistics has historically been also another space where that's been the case. More recently, not so much, especially with what happened in April. The Inland Empire, as an example, saw some pretty significant softening. Rents migrated higher. We're taking a contrarian view there because we've got a team that's pretty local and has been local for a long time. And we've been able to pick up some really attractive assets at 20, 30, 40% below replacement costs, where we know, or our conviction is that over the whole period that we'll be able to reposition and get that rent back. But you have to be very just prudent in terms of what your underwrite is at the end of the day. I mean, that's to the point of this Boston asset or some of the stuff we're doing in logistics is, if you have conviction, great, but how are you underwriting any potential rent growth? That's pretty important. And if it still meets your targets, we're still all in.
Well, a couple of things. You mentioned Boston. Anecdotally, we just finished a 153 unit complex outside of Boston, and we're about 82% leased up as of today. We started over the summer and rapidly approaching stabilization. And what we're hearing from the market is a sub 5 cap valuation. And at first we were obviously pleasantly surprised by that, but it seems that a lot of other people in that market share your thesis. So that was welcome news to us. I think what I've experienced, and this is back to the industrial market and valuations being stretched, is really the reality of some mark-to-markets. So like I had previously talked about, we may have bought properties where rents were $3 or $4 and the market was $7 or $8. Now you see it's being advertised, oh, there's a 15% mark-to-market play. Well, a 15% mark-to-market play is market because you have costs with releasing. So you have tenant improvement costs, leasing commissions, and downtime. So a 15 to 20% mark-to-market doesn't really get you where you need to be to create value there. So I think there's some overvalue in the industrial markets, where I have seen better opportunities in secondary and tertiary markets than the primary markets there. The other place that I see most often is multifamily, especially in the Southeast right now. I haven't seen a lot of trades, but even when you're speaking with brokers or speaking with people in the market, there's just a wide bid-ask spread, and it's hard to transact there.
Totally. Yeah, I mean, fundamental to our business is acquiring assets at what we view as a discount to fair market value, or we're an originator of a lot of preferred equity, often highly structured, in many cases to help de-lever existing portfolios, and through that avenue having, equity subordination. And I think just being able to amortize a discount and having less of your return come from business plan or end of term capital at exit, it just benefits you. And I think you're both kind of alluding to it, which is it's hard to fix basis. You get a good buy, you feel a lot better.
I was going to say you make money on the buy.
That's right.
And it's all about your basis. A low basis, you can weather many storms.
That's right. So kind of jumping out to a long-term going forward view, we've talked a lot about aging population. Delayed household formation is obviously, a key factor, and then demand for data center space, driven both by AI workloads. But I feel like we have stopped talking about the cloud, even though that's a big demand factor there. How do you think about demographic and technological trends and how they're going to reshape capital allocations, in the next decade?
That's a good question. Need to think about that one a little bit. You can.
I have something, but it's not really on the real estate allocation part, but on the capital allocation and capital coming into things, you can see it's already starting with like the noise about changing the way 401ks are structured and what's available to them. There's a democratizing effect in what people can invest in and what's available to who. When we talk about even more capital going into like the private system and private real estate investment, I think that is something that is going to exponentially pick up speed over the next 2 to 3 years, and could be a very large new source of U.S.-based capital seeking to be placed. So that's something to keep an eye on. Very hard to predict the next AI.
I wanted to leave that one to you two.
I wouldn't be sitting here if I could. Maybe pickleball should get an allocation because that seems high growth.
Yeah, I mean, so touching on the point that you just made with wealth or quote unquote retail capital becoming a greater source for GPs, I think it's great, but I also look at it with pretty significant caution, because when there's a ton of capital in the system chasing the same deals, we're going to run into a very tough valuation environment where you could potentially see cap rates coming down, and not necessarily for the right reasons in terms of just the quality of real estate. With regards to AI, look, some of the sectors that might get pretty significantly impacted it might continue to be on the logistics side. We've seen the robotization of warehouses and how that plays with the need for space, whether it's vertical or horizontal or smaller spaces, because you can, if you have robots, you don't need that much space for humans. Away from that and the play that you're seeing in data centers, I don't know that there's going to be much of an impact with like housing in general or other sectors, to be honest.
Great. I think we are almost out of time. Maybe time for one question from the audience. All right, great. Well, thank you so much.
Thank
Thank
you.
you.